Okay, good morning, everybody. And I'm really pleased to be here today and welcoming you to this panel session, another panel, embracing a new economic era. Finance as a catalyst for transformation. Wow, that is quite a big topic, and we've only got 40 minutes, so we're going to keep it brief. I've asked all of my panelists to keep their reflections to 90 seconds, you'll be pleased to know. But we're going to try and solve some big problems today. My name's Hannah Cool. I'm Chief Operating Officer at an organisation called Bankers for Net Zero. We convene the UK finance ecosystem. And we're well aware that we are living through a period of economic change, economic transformation. We're also acutely aware that the world is incredibly complex. You need only look at the papers in the morning. How do we create a system which recognises not only finance as we know it, but sustainability and impact? How do we rewire the economic system? And it's a question that we've been asking ourselves for a while now, and there are many of the answers at our fingertips. It is a case of working together and really moving into how do we implement, how do we act? So that's what the focus of today's discussion is going to be. I am so pleased to be joined by an amazing set of panelists. We have Gavin Starks, give us a wave, who is CEO of Icebreaker One. We have Thomas van der Heijden, who is CEO of Brink. I'm really enjoying the waves. We have Sir Andrew Steer, give us a wave, who I'm so pleased we have today, who is Professor of Practice, Economics and Sustainability at LSE and former President and CEO of the Bezos Earth Fund. Danielle Boyd, great wave, ESG Manager from M&G Investments, and Jessica Bingham, Head of Sustainability Strategy at ACCA. Wow, what a lineup. Okay, so Andrew, I'm going to come to you to kick us off if that's okay. It is a very confusing world we're living in now, and the rhetoric around sustainability might be perceived as potentially quite dangerous right now. What have we got to be positive about, and what should we be basing the rest of this conversation on in terms of the foundations for progress and commitment to sustainability?
In 90 seconds?
In 90 seconds.
Right. Well, it's good to be here. Look, we are going through a time that's quite challenging. Politics has shifted, but it's important to remember that the election in the United States changed a lot of things, but it didn't change the laws of physics, and it didn't change the laws of economics. There was a time, 30 years ago, when we actually could make the point that addressing climate change would be a good idea, but it will hurt your economy. Because it's actually quite expensive to move to a greener path. We've now moved way beyond that. In 80% of the world's surface, it's actually cheaper to invest in renewable energy. And there's a new economics of this century, which says that actually, if you make bold, smart action on climate change, it will lead to more economic efficiency, it will drive new technologies, it will lower risk, and it will reshape expectations about a much better future. Those four things together actually lead to all kinds of exciting animal spirits, as John Maynard Keynes would say, new investment, more competitiveness, more jobs. But here's the important point. We can now make an absolutely convincing case that climate action will help the economy as a whole and will help society as a whole. That doesn't mean that every single company will benefit. It doesn't mean that every single region of the country will benefit. And we in the environmental movement have done a bad job of putting people in the center. And that's precisely why we've had this political backlash. We need to mend our own ways.
Okay, so we've got to communicate better, but we've got to unlock the value by assessing risk in a more consistent and fair way. Am I hearing that right?
100%, yes.
Okay. Now, I think a big part of that, and we hear it a lot, is we need better data. Something I hear all the time and is a really strong foundation in my organisation is we need less reporting, but better data. This move away from compliance into action and value driving through organisations. Now, guess where I'm going to come next when we talk about standards? She's smiling. Jessica, standards, consistency, a need for better access to information is something we are going to hear a lot about because we've still not cracked it. So tell us the perspective of ACCA.
Yeah, it's a difficult one because standards are very useful and reporting is obviously informs decision making, but I think at the moment, especially, reporting is kind of seen as...
Can everyone hear Jessica?
Can everyone hear me? Reporting is often seen as the end goal instead of strategy and sort of decision making. But I also wanted to talk about sort of the development of frameworks and standards, because we have seen the introduction of the CSRD and now the rolling back of the omnibus.
Guys, can everyone hear Jessica? You're all right. Yeah. Okay, sorry.
It's just you. And something that we're really missing is that don't quote me on this statistic, but around 90% of businesses across the globe are SMEs, and they're very small, and a lot of reporting and standards development has been made for those large organizations and firms with complexity included. And what we really need to do is be able to adapt those standards in the right way so that SMEs can be involved rather than being impacted at that supply chain level. And I can see Hannah looking at me. She probably can't hear me and she won't be able to respond. But what's important is that we start bringing SMEs proactively into discussion from the very start so that they can collaborate on policy. So thinking about things like the voluntary SME standard within the EU, but also how we're going to roll that across the world. And we're seeing some really good initiatives in Malaysia and South Africa, where they're trialing different SME standards and try and bring them together so that reporting isn't seen so much as a burden, because it is important to make sure that we have the right data to inform the right decision making. And I don't think that will ever go away. But at the same time, it is being very much seen as a burden rather than having the narrative framed around innovation, resilience, and sort of data-driven decisions.
I think that's such an incredibly well put point, right? How do we move from burden to benefit? Now, we launched a report yesterday, which is the UK voluntary SME standard. And I think there is this focus on the markets at the moment being very top-down. We've created a very top-down, top-heavy system, regulate the biggest businesses, onus on the biggest businesses, but that ultimately filters down through the system, doesn't it? Unless we can build something which is bottom-up, it brings along the smallest organisations in our marketplace. How are we ever going to understand where impact really sits, what the risk really is, and then ultimately how to offer incentives? Now, to that point, maybe I'll come to Thomas. What's the difference then between where you see regulators playing a role and the mismatch in terms of what's practical at a business and operations level?
Yeah, so I'm the CEO and co-founder of Brink. We're an AI startup based in Berlin and in London, which focuses on building technology to help ESG and sustainability teams with a lot of the growing manual workloads that have emerged over the last few years. Workflows around reporting, around supply chain due diligence, and so forth. And I think one thing that we've seen is that a lot of the debate has essentially been hijacked by politicians and regulators saying, this is too burdensome, this is too difficult, this is too hard for people to do, and so let's roll back and not do it. And it's kind of an interesting dichotomy we're seeing at the moment, because at the same time technology is accelerating at such a fast pace that it's able to do a lot of work that previously we didn't imagine technology would be able to do. And so we're seeing this sort of tension, right? People are saying, this work is way too hard, so let's stop doing it, let's roll back the regulations, but at the same time, we're seeing technology being increasingly able to do a lot more than we could have imagined before. And a lot of the leading companies and financial institutions that we work with are actually starting to invest more into technology, into AI, into infrastructure right now from a sustainability perspective, because they know this work is not going to go away, and it's actually going to increase in importance in the coming years. So I think that's kind of the tension we're seeing right now in the sort of regulatory, political pushback, but at the same time people realizing that they do need to invest in the infrastructure that's going to be required for the years to come.
Thanks, Thomas. When we think about data collection, and as you call it, the rollback, do you actually think we're getting to a sensible middle ground though? Because really there is this balance between top-down regulation but trust in information. I'm going to come to Gavin in a minute, who is really focused on the underpinnings of how do we get to trusted, validated data. So
I would say that we're not in a great middle ground, I would say, yet. I think further to what Jessica was saying before, I think what we, for example, see with a lot of within the sort of supply chain with SMEs is that large companies are still demanding a lot of this information from SMEs, but SMEs right now don't have a really good way of understanding what it is they need to really be doing, what kind of information they should be collecting, how they should be collecting it. and as a result, they're getting a lot of top-down pressure within the supply chain, but there's not really a good understanding of what exactly should be collected and how. And so it's still a little bit chaotic, I would say. And I think as a result, the data's still being asked for, but I think we could use a bit more understanding of what exactly should be demanded, especially within the SME space.
Okay, fantastic. Actually, I can keep these on. That's not too distracting at all. That's an amazing juncture to bring Gavin in. How do we help SMEs? What is the approach to collecting data that banks and businesses alike, big businesses, can trust?
So I think building on many of the comments already made, SMEs are lacking in time, they're lacking in money, and they're lacking in the understanding of how to engage in this. So we need to be able to create something that makes it trivial for them to engage, but still have them retain agency in the process. And that's a really difficult balance. So we need to automate and basically do the work for them, and yet give them control over how everything works so that they can maintain trust in the systems. And I think when we look historically at the way that the standards have evolved, it's been very top-down. And it's not incorrectly been led by scientific analysis and how do you measure things and so on and so forth. But on the ground, it really kind of doesn't matter that much. We need a small number of pieces of information to flow to inform decisions for the mass market. And when we think about the number of organizations that are able to engage in this process, if we're going to address 80 or 90% of the SMEs in the country, we need something that is utterly trivial for them to engage with. And so one of the programs we're leading with B4NZ and many other organizations is to automate part of Scope 2 reporting and part of Scope 1 reporting by getting access to smart meter data, that flowing into the carbon accounting applications with one-click permission from the SME, and the reporting information then flowing into the banks and financial institutions. So there we've now got 9 banks and lenders, including Lloyds and NatWest and Barclays and so on, as lenders looking for reasonable, assured data. So when we think about how do we make a difference in the financial economy, there have been lots of, like I say, not incorrect methodologies and frameworks that allow us to measure things, but everyone does it differently. And that means you end up with no comparability. Everyone has their own way of doing things, whether that's each of the banks having a different way of doing a calculation, or whether different countries even implement some of the standards in different ways. So you end up with a critical mess. And I think what we need to transition to is, can we go from a critical mess to a critical mass of mass scale engagement in green finance in a way that people can trust. And if we can build those kind of invisible wires, if you like, behind the system to let the data flow, and with this Perseus program, we're getting 30-minute resolution data from an electricity smart meter with its carbon intensity at the time and location of use. It's highly sensitive information. So it has to be dealt with securely, it has to be dealt with consistently, but we get that to flow through, and we've got to the point now where the Welsh Development Bank has issued a loan using that process. But it's not trying to measure everything, it's just, can we do one thing well? If we can do one thing well, we can go far together, and then we can do the next thing. So it's taking maybe a view from the other end of the telescope and saying, can we drill right down to one thing that everybody can do, and then build out from there.
That's amazing. So this session is about a new economic era, right? This is about rewiring a financial system that has been built to focus on one measure, if you like, when we look at good, bad, and finance flows. This is about now bringing in a new paradigm. This is about bringing in energy use, in this case, in the case of Perseus. But what I'm hearing from you guys is standards and consistency is important, trust in data is important, but building from the bottom up is the only way we can get that right. Okay, so it's kind of building blocks on top of a system that we already have. But the only way, correct me if I'm wrong, this becomes a workable solution, we really start rewiring the economy and driving new behaviours, is if there's an economic incentive at the end. So Gavin, you talked about the Welsh Development Bank offering a sustainability-linked loan from the back of trusted data. Now, why is that different from what's already available? Because I hear you all cry, there's lots of sustainability-linked products on the market, are there not? Or are there? So maybe let's drill into that. But I think what I'd love to hear from Danielle is, how are M&G using sustainability data? And what does good sustainability data look like to you? And how do we start to deliver market incentives?
Can you hear me? I'm actually still adjusting to my surroundings, I think, and my first professional silent disco. I think I'll keep them on. Yeah, thanks, Hannah. So M&G, for those that don't know, we're a savings and investment company. We've got a global footprint, a global portfolio, around 340 billion in AUM, which is quite a lot. We updated our sustainability strategy this year, and I think what that did is reaffirm some of our ESG commitments and strengthened our strategy, strengthened our approach to actually delivering sustainability outcomes, which probably bucks the trend a little bit of the last 6 months. And maybe linking to what you were saying, Andrew, first, about risk, I think that's something that really kind of powered our sustainability strategy refresh. Is actually, I think the last 5 years or so, the conversation around ESG and maybe climate more specifically lost its way a little bit. I think there was a lot of talk about Paris alignment and kind of net zero, almost for the net zero's sake. And we actually lost that risk angle, which is really crucial for investors, because ultimately we believe that climate change, but also biodiversity loss, any kind of environmental impacts, social inequality, can lead to material financial risks. And if it does lead to material financial risk, that means that we've got a fiduciary duty to our clients and our customers to identify them, to monitor them and manage them. So it's really quite simple, but I think we need to get better at explaining the link between the short-term risks, which you pointed out a few about in terms of it not climate change action not necessarily benefiting every parts of the community or every region, but also that longer-term systemic risk. And that's the difficult thing to communicate, why we should act now as a financial institution for the benefit of the long term, and what the impact that might have on the short-term financial reward. So in terms of your question around data, I think one thing that really underpins our new strategy is more data relating to the positive outcomes, whether that's, and we've got a whole load of metrics. Obviously you've got emissions metrics, like Gavin was talking about, but you've also got avoided emissions, which are somewhat controversial. You've got kind of the gigawatt hours produced by low carbon. You've got millions of metrics there that we can capture kind of the positive impact, as well as the kind of actual dollar or pound figures that we invest. But I think a key cornerstone of our strategy is really and actually we're probably one of the beneficiaries of all this sustainability reporting regulation and frameworks, because we rely on quite detailed assessments of the companies that we invest in, from obviously the large mid-cap listed companies to private companies, because that helps us understand whether they have transition plans, the quality of those transition plans, the credibility of their targets, and essentially how resilient their business models are to the transition, and if they're kind of prepared for the transition. And that informs our engagement strategy. So that data, which is pretty granular, which is still quite qualitative, which is a bit hard to assess, that's really, really important to us.
Okay. Thinking about that point, I'm going to ask an open question. So first to Mike, please. What does good look like in terms of finance and incentives for assessing risk, and what that means in terms of pricing of risk? What does good look like moving forward? Where do we need to get to?
Well, it is important to remember the journey we're on, and not to be too tough on each other. I mean, I am incredibly impressed listening to you, because we got down to pretty granular issues pretty quickly, and we now have private companies, we have NGOs doing an amazing thing. And if you think about the last 20 years, 20 years ago, companies were saying, oh, I'm doing less on carbon emissions. And it was actually an NGO, World Resource Institute, together with the World Business Council for Sustainable Development, said, let's see if we could figure out how to measure it. And the Greenhouse Gas Protocol came along. Then another NGO said, yeah, but shouldn't we report on it? And that's when CDP came. Another 5 NGOs got together and said, shouldn't we have targets? And that's where SBTI came from. And then different non-governmental and private organizations said, shouldn't we have standards for carbon markets? ICVCM, VCMI. And now there's an alphabet soup that is just growing, which is incredible. And basically all led by NGOs in the private sector, which is very exciting, very encouraging, well done. And we actually have made a lot of progress. Now, it's extremely messy, it's very inconsistent, and I think the points you're making is we now absolutely need to harmonize data, and it's about time that that the government came into the room with some regulations. Another point, listening to all of you, that I would just I'd want to make is that it is very, very important that we lower the burden on SMEs, and you explained that very well. And at the same time, we need to look at the burden SMEs have in paying their taxes. They have entire departments, even if they're SMEs, to pay taxes. They have to honor environmental rules. They have people. And so what's exciting is we're starting to get the private sector to come in the way an audit company or an accounting company would to help them out. We're getting a new industry coming along, and that's very exciting. But as you were saying, Hannah, and your point was so accurate, that until we can show there's a reward for it, we're not going to be able to deliver. And we need to be spending a lot of time asking financial institutions, how are you going to use the data? And not only try and be helpful with the SMEs to help them collect data cheaply, but how are we going to design data so that M&G and others can use the data quickly, efficiently, with reward, and then, my goodness me, I want to be part of this.
Amazing. And I know, Gavin, that's probably a great point for you to come in. There's a lot of overlap in what Sir Andrew is saying with the work that we've been doing.
Thank you. I'm going to try and deal with the noise next door. It's quite difficult to think. But I want to also bring some provocation to this. You know, we want a lively conversation today. So huge amounts of fantastic work, absolutely agree. And we've made a few mistakes along the way. And you know, a lot of the challenge is working out, when you've gone through a process of working out what works, you forget about the 90% of things that you rejected along the way before you got to the one thing that worked. And we still have a process that is very ubiquitous of saying, well, we have a problem, let's create a global framework for the thing, and it is quite top-down. And what we've learned through the SME report is that top-down approach is not fit for purpose for large-scale implementation on the ground. And so with programs like Perseus, we started by asking the question of the banks, you know, what does Barclays need in order to make a decision around a loan? What does the Welsh Development Bank need in order to change the risk profile around its lending so that it's cheaper? And the one thing that came through all of that conversation was we need one piece of assurable data. And in accountancy speak, you talk about reasonable assurance. Previously, and I like being provocative, carbon reporting is effectively a random number generator. And if you have got something that isn't comparable and people don't believe in, you undermine your own markets. And so we've got to really kind of grasp the nettle on a lot of this and say, what is, exactly to Andrew's point, what is the thing that actually makes a difference to financial institutions? We're just in the middle of a piece of work with TNFD, the Task Force for Nature-Related Financial Disclosures, to help them work out what can we do to make it implementable. How do we drive adoption of these things in a way that is palatable by the users? So maybe one thing, one other provocation in the middle of this is to ask, what is the actual user need? And reporting is not a user need. Reporting is an interesting output along the way to identifying what somebody might need to do. But the user need is improving the efficiency in my business, improving my green credentials, reducing my energy consumption, reducing my carbon footprint, deploying loans. Those are the outcomes. the reporting is a stepping stone on the way there. And we tended to, when I think over the last 20 plus years I've been working in this space, we tie ourselves in knots around reporting.
I think a lot of this is now simplifying. With the best intentions, we may have made things slightly more complicated than they needed to be. So my one mission statement is simplify, simplify, simplify. And any frameworks must be digitally enabled, right? Is that common consensus across this panel? We are a digital economy. If we're sharing information and we don't have the approach or common agreement to enable the digital flow of data, we are not doing it right. So if anyone talks to you about a framework and they don't talk about digital data sharing, then disengage, I would say. There you go, there's provocative.
I think, sorry.
But I was just going to hand over to Jessica, actually. Jessica, you were at COP16, right? And
Yes.
we talk about nature finance, we talk about nature as an asset class. This is new. This is new in kind of the financial markets in terms of mainstreaming. What are you seeing, right, in terms of how that links to your world, in terms of driving investment in nature as an asset class and the standards that sit around whether that's good or bad?
Yeah, so it's interesting that nature's new, considering that it should have been there the whole time.
The
And,
whole time.
with climate and increasing emissions, technically we have the whole of time to keep doing that, but nature's the thing that gives us the deadline. And part of the problem, I think, when we think about data, it's easy to focus on GHG emissions and assurance and reasonable assurance, but nature-related data, I mean, if you look at the Corporate Sustainability Reporting Directive, I think there's over 1,100 data points within that. So if you're a small business or even a large business, that's a huge reporting burden. And one of the things that we've noticed actually in all of this is the language barrier and the fact that it's very difficult to integrate nature-related risk because sustainability teams, which involve ecologists, I mean, if you're thinking about large corporates, not SMEs at this level, but if you're thinking about all those people that work within the sustainability team, and then the people that work within the finance team, so the finance professional who has, up until this point, wholly worked in financial terms and maybe has just about got to grips with carbon accounting, but is still a bit confused and doesn't really like the fact that the data's not that reliable. And they just have an enormous language barrier. They cannot talk to each other. They act so siloed. And we often use terms very sciencey without perhaps translating them very well. And if you look at different companies, I think Dow Chemical, they talked about nature-based solutions all the time internally for a while. And then eventually they started to switch it to engineered technological solutions, and they just changed the wording just slightly. And it meant that all the engineers suddenly were slightly more involved, and they could quantify it better, and the risk was better integrated. And so I think one of the biggest things with nature-related data and climate-related data is just the language barrier alone. And then when you get down to that SME level, which is just so tricky, I sort of, to your points about simplification, I think it's really important to not water down the standards, but adapt them and not just remove stuff for the sake of removing stuff. And then when we're thinking beyond climate, we need real practical examples. At the moment, the TNFD have done some really great work, but at an SME level, your CFO is probably also your CSO. You haven't got a sustainability-related team compared to the sort of ever-growing teams within banks. And they need really granular examples and really practical examples that they can use. And those in turn then evidence why it's important from financial flows perspectives, it evidence the benefits, and it improves access to finance for all those SMEs and goes back upwards again. So there's that whole sort of language loop and narrative that needs to be kind of joined up, I think, at the moment.
That's really interesting. And look, guys, I hate to say it, but Andrew, you talked about the role of NGOs and kind of making things happen and moving the market forward. Is there more pre-competitive work that needs to be done here? Thoughts, reflections?
Sorry, I didn't get the last part.
Is there more pre-competitive work, bringing the markets together to agree language, to agree what measured gets managed?
Yep.
Do we need more consistency, and does that mean bringing more market conveners together?
I think the general theme that we see, I think also, within the whole omnibus discussion, also I think a lot of what the standard setters are doing, CDP was mentioned as one example, a lot of the other rating providers, is a sort of general theme that we need to drastically simplify. I think the term simplify gets thrown around a lot, but what does that actually mean? I think what we need to really think about is, yes, we need to simplify, we need to reduce. We can't have 1,100 data points. We can't have 100. Like maybe we go it all the way down to half dozen, but we need to know what those half dozen are actually, like why are we collecting those? I think one of the things that would really help SMEs is if knowing tangibly, if we go and spend resources on collecting these 5 or 6 data points, what is it going to do for me? What is it going to do for my business? And how is it going to help me? I think that's oftentimes lost in the whole discussion, right? People talk about reporting, burden, compliance. Nobody really explains in a sort of easy to understand manner to a lot of companies why they should invest, because it's always thrown at them as a huge, huge burden, huge amount of data. We don't know why we're collecting it. We don't have the resources. But I think if we had a more science-based, evidence-based, revenue-based, finance-based explanation for it, just go collect these 5 or 6 data points, I think people would have more of a commitment to actually invest their resources and time into collecting them. And I think a lot of that goes down to explaining it better, right? Explaining it better and helping them understand better why it's important for them and their business, because otherwise they're going to keep putting it like way down the priority list.
Andrew's chomping at the bit to come in.
No, just to agree.
Oh, great,
Agree
perfect.
with you. Do we need
Agree,
more,
disagree?
Do we need more pre-competitive discussions? Yes. NGOs deserve huge credit. And because they're NGOs, they tend to want the perfect. They want data on everything.
We don't.
And they're not so good at simplifying for normal people.
We are.
So I'll give you an example. It's slightly different. Do you remember when they launched something called the Trillion Trees Initiative? And it was Davos launched it, and I went back. I used to run the World Resource Institute, and I was the CEO. And I went back from Davos, and I told our guys, I've just been to the Trillion Trees, and the immediate reaction was, these are very serious ecologists. They said, but a tree is not the right unit of account here. The right unit of account is maybe hectares of ecologically healthy land. So I said, yes, and good luck explaining that to the guys that are actually going to implement it. And the message of the Trillion Trees was, there used to be 6 trillion trees in the world. There now are 3 trillion trees in the world. Let's add 1 trillion trees more. Simple as that. Everybody gets it. Is it right? Well, no, we could easily complain that it's, not exactly right. But my goodness me, it's quite useful at sort of, and we need to, so what's the point is, I remember visiting the head of a really bad performing forest company in Indonesia. And the guy, head of the whole thing, lived in Singapore, quite a dark company really. He said, look, it's in my interest not to be hated. I would love to do what you guys want me to do if you could only agree with each other. If you could only set standards. The problem is if I follow your standards, Greenpeace will come along, or TNC, different groups will come along, and they'll criticize me, so it's no win. Can you please get together? The private sector, especially the big financial companies like Danielle's and so on, they could play a very valuable role. Let's get together every year, have a summit, and try and forge precisely the kind of simplicity we're talking about.
So I love that approach, and I think we need to get better at doing that. I will come to you, Danielle, but I just want to caveat this with, we talk about financial incentives. I know lots of the banks are thinking about collecting better data, packages of incentives. Gavin, you're working with the Treasury on how do we offer markets incentives and tax rebates on the basis of collecting better data potentially. We've also got to think about the counter, Danielle, to your point around managing risk more consistently. So how do we price risk? So when we think about the risk of inaction, i.e. if you're not sharing information and we don't understand what risk you are, it won't be that you access more products or we give you a discount or we offer you lower cost of capital for a loan. What we're actually going to do is make you a higher risk premium, right? It's actually recognizing that the cost of action is saving you money because there's a risk profile associated with not doing something. We're not very good as a market of pushing that forward at the moment because we haven't agreed. Would you agree, or is there a different perspective that anyone on the panel has?
I think the challenge is there is so much uncertainty in the climate science, but then when you try to also then map that onto the financials, you create even more uncertainty. So the example is there's quite a lot of, well, it's quite difficult to, as a investment firm, to think about how the physical impacts of climate change might impact our portfolio in 20, 30, 40 years. There's some really good thinking. I challenge your previous comment that actually I think the investment industry does get together a lot, and we have come up with some really strong standards and frameworks that the whole industry has coalesced around. And one of these more recent advancements is around how to identify and manage physical risks to the investment portfolio. And one of the things that you need to do is first understand how actually taking a whole portfolio is quite difficult, but even if you take a single asset, so you need to understand how the asset is going to perform in a scenario without climate change, for example, or within a scenario without any nature-related impacts. Then you also need to then model probably a couple of scenarios, maybe a 3-degree scenario, maybe a 2-degree scenario, maybe a net zero scenario, and then try and figure out how the asset's going to perform. And that takes a lot of assumptions, and then you need to translate that performance. Maybe it hits the asset, say it's a hospital or something like this, a kind of big, kind of key social infrastructure asset. You need to understand how that's going to impact the operational performance or the value of the asset. And then you need to turn that into a metric, going back to what you were saying, that the fund managers are going to understand. So how's that going to impact the IRR, for example, or the value of the asset? And so there are so many assumptions, there are so many steps involved that it's actually quite difficult to do all that assessment and accurately price in. There's a lot of uncertainty around trying to price in the risk. So I think
maybe that's
one
where
of the
we need the
challenges.
market together to get a standardised risk curve and cost curve, right? I know the insurers are talking about this a lot as well. Jessica, did you have something to add?
No, I wanted to jump in and say these are really excellent points, and it's something that's very much needed, but what we haven't discussed, probably don't have time to discuss, is the real talent shortage that goes alongside this. I think there's around 300,000 climate professionals in London, but a lot of the discussions we're having today are very London, Western-centric, and the Global South are forever frustrated that they're not involved, but also the skills don't sit there across the world, and it's not evenly spread. So when we're thinking about developing frameworks and sort of metrics and how we get to those decisions, not everybody is necessarily included in the conversation in the right way, but also not everybody has the right skills to be able to get involved in the conversation. I think that's a real barrier to developing consistency at the moment.
Thomas, if you make a point, and I think we've got time for a couple of questions, so if anyone wants to pop up their hand, and we'll get a roving mic to you, but Thomas, you go and I'll take a look.
Yeah, I was just I'm obviously biased when I say this, but I think if you listen to, for example, Sam Altman, right, he talks about AI as a great tool to bring the cost of intelligence down to zero, right? I think we were just talking before the panel about, how increasingly, consulting firms, law firms, and so on, the sort of entry-level jobs are being replaced by AI. I think there's a real talent shortage, I agree, within the ESG and climate space. I think there's a real, again, an opportunity to kind of go back to the beginning of the talk to kind of blend what's happening in the technology space to kind of help people get trained up way faster than they would have historically been able to do, and gain that necessary knowledge at a much lower cost and a much faster timeline than would have been able even a couple of years ago. So I think there's another real great opportunity to kind of start to blend those two worlds together.
I'm not sure if a roving mic is coming, so you crack on and I'm going to do some
just
hustling.
going to challenge that and say we do need pace, but from maybe perhaps an ACCA perspective, we still need rigor and quality within the learning and upskilling that we're doing. And so that's one of the challenges I think with AI at the moment is you can upskill people as quickly as possible, but do they have the right qualifications and certifications, and are they held to account in the right way? And that's probably one of the challenges we're seeing at the moment with carbon accounting and how that's measured and monitored at the moment. But yeah, sorry.
No, of course. Question?
Hi. Historically, a great amount of change has been achieved through shareholder activism and investor activism. And I'm just wondering what opportunities there are for the finance world to actually engage with those actors more directly to drive this change forward and really sell the complete picture of where we're going. Thank you.
I might actually kick off with that one, if that's okay. So Bankers for Net Zero, we're a convening organisation, and our role as a not-for-profit is to bring together banks, corporates, NGOs, activists, civil society alongside industry, right? You know, our whole portfolio is responsible lobbying to a certain extent. How do we design policy that works for the market? Brilliant, a roving mic. But does anyone else have anything else to add while I run back to stage?
I could add to that on the activism point. I think most effective citizen action isn't getting on the streets. It's calling up your pension fund, your insurance company, your bank, and asking them 3 questions. 1, what is your plan? 2, how are you going to measure and evidence your plan? And 3, how is your chief executive's compensation tied into the delivery of those targets? So 3 simple actions.
Yeah, I agree. I think I'd be more than happy if anyone called up M&G to answer those.
Love that.
But I think on terms of shareholder action, we're about to release our climate transition plan, and that's very much a key pillar. Is our role as shareholders of companies, as bondholders of companies, or investors in private companies. There's a huge debate. Everyone's probably familiar with the power of divestment over engagement. I personally, so far, I'm more in the camp of engagement remaining invested, because I think being there to have those conversations with companies again and again if we need to, putting the pressure on, and then using our vote if we need to escalate, voting against the Renew Nation policy or voting against the board of directors is more influential than handing our shares to companies that don't want to have those conversations.
Love that. Thank you. Pablo?
Yeah, it's actually more a request for feedback than a question, and I will deep dive and afterwards. How do you see the engagement of behavioral science to complement what you're doing, considering this is a paradigm shift, it's a cultural
Great question.
matters? And the other thing is regarding the use of that data for the banks. You've been mentioning about using that for loans. Wouldn't be also useful for instance, what happens in Singapore, where banks partner with solution providers to support transitioning those companies, or to provide incentives. They get their green rating for the bank, and then they get additional incentives on the back of that. So feedback.
Love that. Behavioural science in driving change, but also the bank's approaches to incentives.
I'll have a go. At the heart of any change is what's the incentive structure that is driving the behaviours. And so one of the challenges we've had is we've got our existing systems which have been built up over decades that incentivize us all in very specific ways to generate economic growth. And then we're coming along saying, having spent however many centuries measuring the rate of change of one thing, which is just money, we've now got to measure the rate of change, well, maybe 1,100 things. And the system is not fit for purpose to do that. And therefore the incentive structures that we can imagine, we're still at I would say at the foothills of working out what those incentive structures might look like. We've tried things like the carbon markets, which got off to a bad start and then got better over time. And that last word is the important one, is we don't have time. We must move radically quickly. So I think the incentive structures require very bold engagement and partnership between government, industry, the financial sector, to say that the future just needs to have this hardwired so that all money contains and embodies its nature and more holistic impact around climate and so on, so that we can generate the right financial structures, whether that's increased interest rates on savings for people who are doing well, or whether it's lower interest rates on all forms of debt, whether that's an overdraft or a mortgage or a loan or whatever. And I think that's the journey we're on, is how do you weave those things together so they're systemic in the system, not an edge case of green lending.
So I think this is a really cool point about behavioral science, because at the end of the day, you can have all the compliance markets you want in terms of data requirements and so on, but unless the SMEs or the corporates believe in this stuff, unless the shareholders believe in this stuff, it's not going to happen. It's not going to happen anywhere near fast enough. And we need to be much more sophisticated about this. And I think if there's a problem we've fallen into, I say that as someone that's been very engaged in it, it's that it's more that we want to regulate things. And I think the environmental movement has grown up over the years to stop doing bad things as opposed to doing good things. And what we need to do is to inspire a little bit more using the most modern and up-to-date, which is exactly the same in, say, recycling. You know, I spend half the year in Washington, D.C. Nobody really is interested in recycling there. Last week I was in Denmark. They really are interested in recycling there. Why? Well, lots of reasons, but it's something deeply embedded in culture, but culture can be changed.
Move very quickly. It's an interesting one. I think the two go together. Is that me? No. Behavioral science or behavior change, and the incentives, because at MG we offer a lot of sustainable products. We have our kind of sustainable version of our main pre-fund, which is our flagship product on the asset owner side. We have a range of products. Our asset manager has a range of products from nature and biodiversity solutions, climate solutions, transition solutions. But we need the incentives. We need them to perform better or as good as those that have the wider universe, that invest in a wider range of assets. And to do that, we need a kind of the economy shift. So the two come hand in hand, and I don't think you can have one without the other.
Amazing. Well, guys, our time is up. It's gone wildly quickly. I might ask you each for a one-sentence takeaway, or even, and if you can make it a word, even better. But look, it's been fantastic to have you all with us today. We've talked through everything from engaging SMEs, thinking bottom up, so inverting the system. We've talked about digital infrastructure and the guardrails for sharing data. We've talked about the role of NGOs and pre-competitive efforts to align on approach, language, standards. We've talked about the role of new standards to drive investment in climate, energy, nature. And we've talked about the role of behaviour change in how we make this all happen and how we make it quickly. So I think that is the definition of rewiring the system for a new economic era. So well done all, you've met the brief. Thank you all. You can find our names, follow up. One sentence, one word.
I'm going to quote Rebecca Solnit. Hope is an act of defiance.
Love it.
Simplify, but do it in a smart way.
Oh, brilliant.
We need to embrace two seemingly inconsistent things. One, we've made a lot of progress. Two, we're nowhere clear where we need to be. We need to work together. It takes a village. We need to complement each other and go forward with energy.
Well, I'm ready to work with you all. Yeah?
That was a long sentence, Andrew. Mine is specifically for the finance industry. Let's keep the ambition and let's not lose sight of that kind of long-term systemic resilience and risk, as well as the short-term goals.
Lead us out.
I'll use one word to use less words. Partnership.
Powerful. Thank you.